Well, our reading here, aggregate output prices example where the government spending encourages the production of ethanol to mix with your gasoline. Okay, personal income is national income, that whole list we had, plus transfer payments. So transfer payments to household end up as personal income. So if you're getting a Social Security benefit from the government, an unemployment benefit from the government, this goes into personal income. But now we're going to subtract out these indirect business taxes because they don't go to individuals. We're going to subtract out corporate income taxes because they don't go to individuals either, and any undistributed corporate profits. Remember, corporations can pay out some of their profits, or all of them, I suppose, as dividends. That is personal income. But to the extent they retain earnings and don't pay it out to the shareholders, that's undistributed corporate profits. These are not paid out to people, so we want to subtract them from this whole big thing, national income, in getting down to personal income. And the main thing we want personal income for is to calculate personal disposable income, and we just want to subtract off personal taxes there. So it's the after-tax income of the population. Well, the reason we like that, it's a good indicator of consumer spending. When disposable incomes are going up, people spend more. When they're going down, they spend less. So that's why it's a pretty good indicator and something that economists like to watch, especially those that are trying to predict changes in overall GDP. So remember the big deal relationship here? GDP equals consumer spending plus business spending on investment plus government plus net exports. Exports minus imports. That's our expenditures approach. From the total income approach, we've got taxes rather than government spending. We've got savings by consumers, and we've got consumer spending. So of all the GDP, what do people do with it? Well, they either consume with it, or they save it, or they send it off to the government in the form of taxes. So we're going to take these two and we're going to put them together and cross out those C's are going to cancel out. We subtract that from both sides, and this is what we end up with. We do just a little bit of rearrangement on this and end up with this right here. So this is kind of a big deal too. We'll see this in a couple of forms. So let me just go over what that tells us. It says that savings equal business investment spending. And I think I said earlier something about raw materials with relation to investment spending, and I didn't mean to. So I take that all back. This is spending by businesses on physical goods for production, their capital stock. And then we put those other four terms in parentheses. So we've got G minus T. What's that? Well, that's government spending minus the taxes they take in. And so government spending minus the taxes they take in at different price levels. I'll spend just a little more time on that one, okay? So that is a long way around. So I don't want you to get too confused about that ISLM. If you can remember so far, the IS curve shows the equilibria in the goods market. We can draw an LM curve for each level of the real money supply, plot out some points, and those points are the aggregate demand curve that shows the relationship between the price level and real aggregate income. So another way to say that is we kept the nominal money supply constant when we drew the LM curve, and then as we varied the price level, nominal money supply stayed the same, but prices up, real money supply down, prices down, real money supply up. That's how we got our aggregate demand curve. And this is what we were really after anyway, is a downward sloping aggregate demand that says, well, at lower price levels, aggregate demand And what's aggregate demand? Well, C plus I plus G, government spending, plus net exports. That's what we've plotted here. So now we've got an aggregate demand curve for the whole economy. Now we need an aggregate supply curve. Well, we're going to define aggregate supply curve over 3 time horizons. In the very short run, aggregate supply doesn't change. Input quantities are fixed. Well, we're not concerned with the very short run. We're concerned with the short run and the long run. And how do we differentiate those in this model of the overall economy? Well, we're going to say in the short run, input prices are fixed, especially wages. So in the short run, we'll hold input prices fixed. And this seems a little odd because we're going to allow the prices of final goods, this price level on the y-axis, we're going to allow that to vary. But in the short run, we're going to hold input prices fixed. And primarily wages, but it could be other important inputs like energy. In the long run, these input prices can vary, and that's what's going to get us back into equilibrium, right? Disequilibrium is a short-run phenomenon. We get away from our long-run equilibrium, there's got to be some sort of mechanism to get us back. Well, that mechanism in this model is changes in input prices. We'll see when the economy is producing at a high level, an expansionary economy greater than full employment. This is going to put upward pressure on input prices. And when we're in recession, unemployment rises, we're at less than full employment GDP, then there's downward pressure on wages, as you could think of workers competing for jobs in a recession and companies competing for workers in an expansion. So that's backwards here. Starting out at equilibrium, if the government increases aggregate demand through either fiscal or monetary policy, shifts it out like that, the price level rose, didn't it? And in the short run, we got an increase in output. But what happens in the long run? Well, remember what determines long-run aggregate supply. It's the capital stock, it's human capital, it's labor and technology. Well, none of that has been affected by the government or monetary authorities trying to shift this aggregate demand curve out. We're at temporarily over full employment, but in the long run, input prices rise. When input prices rise because of competition for inputs at over full employment, it shifts this short-run aggregate supply curve to the left. We get a new equilibrium. Prices went up again, but what was the effect on real output in the long run? In the long run, no effect on real output of shifting that aggregate demand out, increasing aggregate demand, when it's already at long-run equilibrium on the long-run aggregate supply curve. Excuse me. Okay. What happens if aggregate demand decreases? Well, remember the story of the classical economists is whatever the reason for this decrease in aggregate demand, this puts downward pressure on prices. So initially our move here to here decreases the price level in the short run and decreases GDP in the short run. And now we're going to get a similar in the long run. Input prices fall. Short run aggregate supply shifts out to the right, increases as money wages fall. Prices fell again, the price level fell again, but we got right back to where we started on long-run aggregate supply at full employment. So that's the equilibrating mechanism. Gets us, it's changes in these input prices. And remember, This price level here is the price of output. What we're fooling around here with is the price level for inputs. And we've said those stay the same in the short run, but adjust in the long run. So those are important points to remember when we get to monetary and fiscal policy. And stagflation here, well, stagflation, that's just two words put together, right? Stagnation and inflation. And stagflation says, well, the economy is, growth-wise, is doing poorly, but we still inflation. So it's just like we saw in that last slide, some decrease in aggregate demand, aggregate supply, a supply shock. We start here, and a supply shock decrease of an increase in the rate of growth of the money supply, R2. Well, we know about equilibrium in the money market. Increase in the growth rate of the money supply, at least in the short run, decreases real interest rates, increases production, output. But remember from our graphs, in the long run, because we're starting at full employment. So we increase the growth rate of the money supply, that increases aggregate demand. And we shift up that short run aggregate supply curve. So in the short run, real GDP is going to increase. But what did we say happens in the long run? In the long run, because we started at full employment, that's where we're going to get back to. We lose that short-term increase in real GDP, and prices go up more. So B, I think, is our correct answer. Let's make sure. Yeah, it's the right answer. What's wrong with A? Decrease real interest rates in the short run? Yeah, that's fine. Increase real GDP in the long run? No, 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 no. You can't increase real GDP by printing money, not when you're starting at full employment. And C says increase the price level and real GDP in both the short and long run. Well, that's wrong here, because in the long run, we aren't going to increase real GDP. So aggregate demand increases. We get to over full employment in the short run. That increases those wage pressures. Input prices go up. Short run aggregate supply decreases. Output declines in the long run, and prices go up a little bit more. So this increase in the money supply starting at full employment GDP is going to translate all into higher prices in the long run, with no long run gains in the potential output, the actual output, in terms of real goods and services of the economy. So we'll see some of this when we look at monetary and fiscal policy a little later in the curriculum.